Let's continue the conversation with UBS bank analyst Erika Najarian. She has a buy on JPMorgan and Wells Fargo, a neutral rating on Citi. So let's just start there. Is that your take as well? Was it the guidance number? I mean, it's unusual to see JPMorgan shares down as much as 5% in the early going after earnings, Erika.
Yeah, absolutely. The street really went there in terms of how they were thinking about the revisions to net interest income, or NII. Keep in mind that JP Morgan and the other money center banks are asset sensitive. So the more cuts you take out of the forward curve, the more they theoretically earn. So the 89 billion number that was mentioned in the earlier bit, I think the street was already, above 90 for that metric. And so the 89 was a bit of a disappointment. And also when asked, if we took out the 3 rate cuts that were embedded in, their guidance for the 89, what difference would that make? And we didn't really get a strong answer, a firm answer for JP Morgan. So I think that's really a big part of the disappointment.
So part of it is simply the fact that we very well may not get 3 rate cuts this year and not getting a clear answer, I guess, in terms of what impact that's going to have on the bank.
Yeah, absolutely. And the other thing, too, is, the provision is going to go up from consensus estimates. Those are, those are credit costs related to better credit card growth. The tax rate was higher. Expenses were a little bit higher because of the FDIC. So net, the stock is ripped into the print, and now you're not going to get a consequent EPS upgrade. I think that's why the stock is taking quite a breather here today.
What about Wells Fargo? You seem more impressed with the number, although I don't think they upgraded net interest income based on Fed path either.
They didn't, but their fee number was quite the blowout. So, you're looking closely to see if there were any sort of one-time idiosyncrasies in terms of what caused that blowout to consensus. But really what was happening there is they earned more in trading, they earned more in investment banking, and they just had overall strength in that line. And I think that's really, really important for the long-only narrative, the long-term shareholder narrative to the stock, right? Because, clearly Wells Fargo is a fixer-upper, so to speak, as they deal with the regulatory issues. And I think that beat in the fee revenue item essentially told the street, look, they were not just cutting costs, but they were cutting costs overall, but using some of those cost savings to invest back into the business. And as for net interest income, Sarah, I think it's too early for Wells Fargo to upgrade their NII guidance. So I think it's still potentially on the come, but JP Morgan not upgrading their NII guidance today makes me less confident that it is to come for Wells Fargo in the future.
We have the Wells Fargo CFO on the next hour, and we'll talk to him about this. But just on the expense side, I think it was a miss on Wells Fargo, and they reiterated the long-term expense guide. I know that's been important for investors who are long this stock. What did we learn about expenses, both there and at some of the competitors?
Yeah, I think there's not really anything to report. Usually the first quarter is seasonally higher. And for JP Morgan, which was impacted by the FDIC, but for Wells and for Citi, they're really reiterating the core expense run rate. So nothing much to report there, other than the first quarter is typically seasonally higher.